Welcome to the deep dive. Today, we're trying to get our heads around a number that's just kind of broken the scale of modern finance. $4 trillion.
Yeah, $4 trillion. That's NVIDIA's market cap. And they've been in this wild race back and forth with giants like Apple and Microsoft for that top spot globally.
It's just astronomical.
It really is. And the speed, the speed of how they got there is what's truly unprecedented, I think.
Right, we're looking at the timeline. They hit $1 trillion in May 2023.
Just over a year later, June 2024, they're at $3 trillion.
And then, boom, even faster. $4 trillion by July 2025.
That kind of velocity, it suggests the market sees them as something much more than just, a successful chip company.
Yeah, it's like they're pricing them as the essential infrastructure, the toll collector maybe, for the entire global AI economy.
Exactly. That's the feeling.
Okay, so that rapid rise, that huge number, it brings us right to the core mission for this deep dive. We really need to figure out, is this $4 trillion valuation built on just, like, better hardware, the actual silicon?
Or is it something else? Is it maybe an unshakable software and platform monopoly?
That's the question. So our goal here is to connect those dots. We're going to unpack the history, the tech bets they made, the unique economic forces.
Yeah, the things that turned a company literally days from bankruptcy into the cornerstone of this whole AI revolution.
So if you want the shortcut to understanding the foundation of AI compute today, this is where we're going to try and lay it all out, right? So to understand how you build a $4 trillion company, you kind of have to start when they were almost a $0 company.
Yeah, the sources definitely paint a dramatic picture there. NVIDIA's founding back in '93, it was defined by just severe financial uncertainty, real knife-edge stuff.
Survival mode, basically.
Totally. That early time, it wasn't a straight line. It was constant pivoting, just driven by needing to adapt, needing to survive.
Their first goal was consumer graphics, right? The RVA chips in 97, 98. That led to the IPO in 99.
Correct. That was the initial focus. But before they got that stability, they hit this devastating technical wall, a real crisis.
And that was the NV1 chip failure, November 1995. This wasn't just a product flopping. This was existential.
Absolutely. Sources are clear. They were down to 30 days of cash left in the bank.
Wow.
And the specific reason for the failure, it really highlights this almost fatal miscalculation they made.
Okay, what was it?
Well, NVIDIA, under Jensen Huang, they bet on what they thought was superior tech. Quadratic surface textures, using complex curves to render graphics.
Aiming for realism, smoother 3D.
Exactly. That was the idea. They even landed a big partnership with Sega based on it.
But then the landscape shifted.
Massively. Microsoft stepped in with DirectX, their new API for Windows PCs. And DirectX became the industry standard, overnight. And it mandated using triangle primitives, these simple, low-poly models for game development.
So developers had a choice.
A really stark choice. Use DirectX, get access to the massive Windows PC gaming market, or stick with NVIDIA's curves and be, frankly, marginalized.
And they chose DirectX. They chose Microsoft's lock-in.
Overwhelmingly.
Yeah.
Because that's where the market was.
So NVIDIA's chip, even if technically interesting, was suddenly speaking the wrong language. What happened then?
It was catastrophic. Just catastrophic.
Right.
Out of 250,000 NV1 chips shipped, 249,000 came back.
Oh my God. Imagine writing that off.
Right. And Jensen Huang himself, he talked about having to personally go and beg Sega to just tear up their contract because the chips were effectively useless.
A total rejection of their core tech strategy.
Complete repudiation. It taught them a really painful lesson, I think. Sometimes the industry standard wins, even if it's maybe not technically the best, just because of that ecosystem power and distribution.
Okay. So 30 days cash.
Yeah.
Functionally dead in the water. What was the pivot? What was the, you called it non-obvious, move that saved them?
It was developing the RV128 chip in 1997, and this is what some call the miracle phase.
Why a miracle?
Because they had zero time and zero money for normal hardware testing, prototyping, iterating, none of that.
So what did they do?
They made this incredibly audacious, almost reckless decision. They relied entirely on software simulation to verify the chip design.
No physical testing at all.
None. They simulated it, crossed their fingers, and sent the design straight to TSMC to manufacture it without ever testing a real physical prototype.
That is just an insane gamble. It's like building a jet engine and just checking the blueprints before you fire it up on the plane.
Completely insane financial risk, but the chip worked. perfectly.
Wow.
It rendered graphics beautifully. It flew off the shelves. 1 million units sold in the first 4 months. It basically saved the company financially.
Okay, so that's the comeback story. But you said the real value wasn't just the chip. It was an insight Jensen Huang got.
Exactly. The long-term strategic insight came from looking closely at the gaming market itself.
What did you see there?
He realized that gaming demands this just obscene amount of computation. The intensity is off the charts.
Give us those numbers again.
Okay, think about an early 3D game like Mario 64. That needed something like 100 million calculations every second. Pretty impressive for the time.
Right.
Now, fast forward to a modern blockbuster, like Call of Duty, Modern Warfare 2. That needs over 36 trillion calculations every single. So,
Really? Just for one game?
Yep. Just to handle all the real-time physics, the lighting, the smoke effects, the enemy AI reacting instantly.
It's the chaos of a video game, you said. Demanding instant calculation at huge scale.
Precisely that. And the non-obvious insight Jensen had was, if our chips can handle that kind of low-latency, high-demand, incredibly complex environment—
The ultimate stress test.
Exactly, the ultimate proving ground. If they could thrive there, they could handle any computationally intensive field. Robotics, drug discovery, complex financial modeling, scientific simulation, you name it.
So gaming wasn't just the market, it was the R&D engine.
It provided the money, yes, but also the technical forcing function. It funded decades of extreme research needed to build chips powerful enough for, well, what eventually became AI.
Which leads us right to that transition to parallel computing. 1999, they launched the GeForce 256, and they actually called it the world's first GPU graphics processing unit.
Yes, this is where they really started thinking beyond just making pictures look good on screen. They defined the term GPU.
Explain the difference again, CPU versus GPU.
Okay, think of a traditional CPU, the main processor in your computer. It's like a master craftsman. It's really good at handling a few complex tasks, one after another, very quickly. Managing your operating system, running a specific program.
Sequential tasks.
Right. The GPU, though, it's architecturally different. It's more like an army of workers. It's designed for brute force parallel processing, handling thousands, even millions, of simple tasks all at the same time.
Like calculating the color for every single pixel on your monitor simultaneously.
That's the classic example. Thousands of simple math problems happening in parallel.
So a small team of specialists versus a massive assembly line.
That's a great analogy. And the key realization management had quite early on was that this parallel architecture, it was perfectly suited for the kind of math needed for AI.
What kind of math is that?
Matrix operations, multiplying huge arrays of numbers together. It's the fundamental computation behind training neural networks and a lot of scientific modeling. Just vast amounts of repetitive linear algebra.
And they saw this connection early.
They did. They started seeding universities and research labs with these powerful parallel computing cards long before the whole deep learning boom really took off commercially.
Getting researchers familiar with their hardware.
Exactly. Building that familiarity, ensuring the people doing the cutting edge work were already comfortable using NVIDIA's specific parallel architecture, planting the seeds for the future.
Okay, so that technical foundation, that history, leads us right into the structural mode itself. The hardware came from that gaming crucible, but the sources we reviewed are pretty much unanimous. The real foundation of that $4 trillion valuation isn't the silicon itself.
No, it's the software, specifically the proprietary software platform, CUDA Computer Unified Device Architecture.
CUDA, launched way back in 2006.
Yeah, 2006. And this, I think, is the ultimate proof of that early strategic foresight we talked about. Jensen took the profits they were making from dominating the gaming GPU market.
Which were substantial by then.
Oh, yeah. And he plowed them back into building this complex software platform, CUDA, a full 10 years before the market really had any major widespread use for it.
That's incredible. You're investing, what, billions probably, into building this supercomputing ecosystem? When most of the world doing heavy lifting.
It's way more than that. It's this comprehensive proprietary suite. It includes development tools, specialized libraries like cuDNN, which is specifically for deep neural networks. It has compilers, performance analysis tools, debuggers.
It's like an entire operating system, but just for doing AI and parallel computing on NVIDIA hardware.
That's a very good way to put it. It's the proprietary OS for AI computation on their chips.
And that proprietary nature is the key to the moat.
Absolutely. Because of the tight integration, CUDA lets developers squeeze every last drop of performance out of NVIDIA's incredibly complex hardware.
How so?
Through optimization. Years and years, decades now, of tuning the software libraries to work perfectly with the specific architecture of their GPUs. Competitors can build chips that look good on paper, maybe even have similar raw specs, but they often struggle to match the actual real-world performance because they don't have that mature, highly optimized software layer. CUDA fine-tunes how the software talks to the metal in a way that's very hard to replicate quickly.
And that translates to developer loyalty, or maybe inertia.
Both. The numbers are pretty staggering. The sources point to over 4 million developers now working within the CUDA ecosystem.
4 million.
Yeah. Think about that network effect. They know the tools, there's tons of documentation, huge online communities for support, countless pre-built libraries optimized for CUDA that they can just plug into their projects.
So if you're starting a new AI project,
for any serious team, using CUDA is just. It's the path of least resistance. It's perceived as the safe bet. It works. The tools are mature. The talent pool knows it.
the switching cost must be insane.
Astronomically high. Imagine trying to retrain thousands of engineers on a brand new, maybe less mature software stack, porting all your existing code and libraries, and you're risking performance drops while you do it.
Yeah, most companies aren't going to take that risk, even if the competitor's chip itself is cheaper.
Exactly. The hassle factor, the risk factor, the retraining cost, it often outweighs the potential savings on the hardware component. That's the lock-in.
So the platform was built, waiting, and then the demand finally exploded. 2001. This is the moment you called the spark. CUDA meets deep learning.
This is it, the inflection point for modern AI as we know it, and it centers around AlexNet.
Developed by Jeffrey Hinton and his team, University of Toronto.
That's right. They were in the ImageNet competition, using a neural network to classify millions of images. But the key thing was how they trained it.
Not on some custom government supercomputer.
No. That's the breakthrough. They used 2 off-the-shelf NVIDIA gaming GPUs, consumer-grade cards, basically. But crucially, they used the CUDA toolkit to program them and unlock that parallel processing power for their neural network.
And the result?
It wasn't just a win. It was like a complete annihilation of the previous state-of-the-art. Blew everything else away.
And that proved what exactly?
Well, it proved 3 massive things almost overnight. 1, AI, specifically deep learning, could actually learn complex patterns from huge amounts of data. 2, GPUs, with their parallel architecture, were the ideal hardware engine, the perfect brain for training these data-hungry models.
And 3.
CUDA was the essential secret sauce. It was the software toolkit that made it possible to harness that GPU power effectively and achieve that breakthrough performance in a way that was actually feasible, even commercially viable.
And the big players noticed immediately.
Instantly. Google, Facebook, later Tesla, OpenAI, all the giants started adopting the NVIDIA GPU plus CUDA stack for their own internal AI research and back-end infrastructure.
Cementing NVIDIA as the foundational provider.
Completely. But then NVIDIA realized, okay, controlling the chip and the core software isn't quite enough. If we want true dominance, we need to control the whole environment.
Which leads to this strategy of full-stack vertical integration.
Yes. This shift is absolutely fundamental if you want to understand why they're valued at $4 trillion. The goal changed. It wasn't just about selling chips anymore.
It became about selling what?
Yeah.
Complete systems.
Exactly. Selling guaranteed, vertically integrated, turnkey AI systems. Selling essentially the entire AI data center stack as a single optimized product.
And a key piece of that puzzle was buying Mellanox in 2019. For $7 billion. Why was that specific acquisition so critical? It wasn't just about buying revenue, really.
No, it was strategic. It was about controlling the nervous system of the AI data center.
Networking.
The high-speed interconnects, yes. Mellanox was the leader in InfiniBand technology. Now, you have to realize, when you're training a giant model, like one of these huge language models, you're not using one GPU. You're using thousands, maybe tens of thousands of GPUs, all working together in a massive cluster. They need to communicate constantly, sharing data, synchronizing updates billions of times a second.
And if that communication is slow or if data gets dropped?
The whole training process grinds to a halt or becomes incredibly slow and inefficient, costing millions in wasted compute time. Standard networking, like Ethernet, even the fast versions, just isn't good enough for this scale. It has too much latency, potential for dropped packets.
Which is poison for tightly synchronized parallel tasks.
Exactly. InfiniBand, which Mellanox specialized in, is different. It's a network fabric designed specifically for high-performance computing. It's ultra-low latency, and crucially, it's lossless. data doesn't get dropped.
So by buying Mellanox, NVIDIA now controlled.
They controlled the whole communication pathway. They already had the brain, the GPU. They had their proprietary NVLink for ultra-fast communication between GPUs on the same server board. And now, with InfiniBand, they controlled the high-speed, lossless network connecting thousands of those servers together across the entire data center cluster. Their specific version is Quantum X800 now.
Controlling the short-range and the long-range nervous system.
Perfectly put.
And that lets them sell the DGX Super POD, which is basically AI supercomputer in a box.
Pretty much. It's the ultimate expression of this vertical strategy. A DGX Super POD bundle includes their latest GPUs like the Blackwell GB200 systems, plus optimized storage, plus that proprietary high-speed NVLink and InfiniBand networking, plus all the enterprise software, CEDA, everything pre-installed and pre-configured.
So the customer isn't buying parts and praying they work together.
Right. Instead of a company trying to stitch together GPUs from NVIDIA, networking from someone else, storage from a third vendor, and hoping it all integrates without bottlenecks or weird bugs.
Which sounds like a nightmare.
It can be. Instead, they buy the DGX Super POD, and NVIDIA guarantees it will work optimally right out of the box.
Okay, I see how that changes the whole economic calculation for the big customers.
Dramatically, they're not really buying components anymore. They're buying, as the analysts say, an entire data center stack from NVIDIA.
And that integration, that guarantee, that jacks up the switching costs even higher.
Way higher. And it shifts the conversation about total cost of ownership, the TCO. It's not just about the sticker price of the chip anymore. It's about the value of guaranteed performance, the faster deployment time, the reduced integration headaches, the optimized efficiency.
That's a structural moat that's much harder for a pure hardware competitor to just jump over.
Much, much harder.
Okay, let's look at the numbers then. The financial proof that this whole vertically integrated platform strategy is actually paying off. That data center segment, it's not just part of the business anymore, is it?
No, it's the undisputed engine. It's driving everything. The growth figures are they're almost hard to believe sometimes.
Give us the recent ones again.
Okay, so Q2 of their fiscal year 2025, data center revenue hit $26.3 billion. That was up 154% from the year before.
154% growth year on year.
Wow. And the momentum just kept going. Total company revenue hit $46.7 billion in Q2 of fiscal 26. It's this kind of sustained massive growth tied to infrastructure spending that's put them in that race for the world's most valuable company.
And the analysts, they're basically betting this continues. That's how we get to these almost sci-fi valuations.
Yeah, the sources mention Wall Street expecting them to hit this $7 trillion club maybe by 2027.
Which only needs about a 56% gain from where they are now, roughly $4.7 trillion.
Yep.
Still huge, but it shows the market believes this isn't a fluke. They see them as a long-term infrastructure play.
Right. But if you really want to dissect the strength of their position, the defensibility of that moat, you have to look beyond just the top-line revenue.
You need to look at the margins.
Exactly. The gross margin. NVIDIA reported a non-GAAP gross margin of 72.7% in that Q2 fiscal 26 report.
72.7%.
Now, that was actually down slightly from the year before, which was even higher, like 75%. But the fact that they can persistently keep margins above 70%, that is the single most important number telling you about their pricing power.
And this is where we really need to dig in, because hardware rivals are getting closer on performance specs, right? We'll talk more about that. But if competitors are offering similar-ish performance, why aren't they forcing a price war? Why aren't those fat margins collapsing?
Yeah, the price difference is stark. We looked at the numbers. Intel's Gaudi 3 chip, their AI accelerator, it's priced around $15,625.
Okay.
The NVIDIA H100, which in some key AI benchmarks is roughly comparable, that sells for around $30,678, almost double.
Double the price for roughly similar raw performance in some cases.
Right. So if this was just a commodity hardware business, if customers only cared about the chip, a 50% discount from a credible player like Intel should absolutely crush NVIDIA's margins. They'd plummet down to normal hardware levels, maybe 40% almost immediately.
So the fact that the margin is holding up, that 70% plus level,
Yeah.
that's the market telling us they're willing to pay that massive premium.
It's the quantifiable proof. That's the core takeaway here for you listening. The market isn't just buying an H100 chip or a Blackwell chip in isolation.
They're buying the whole package.
They're buying the optimized hardware, plus the CDA software stack, plus the NVLink interconnects, plus the InfiniBand, plus the DGX integration, and the guarantee that it all works together seamlessly. They see it as a non-substitutable platform.
And they're paying that premium for what? Software stability, the developer ecosystem, reduced risk.
All of the above. They're paying for the guarantee that their multi-million, maybe billion-dollar AI project is going to work efficiently right out of the box because it's running on the mature, proven, industry-standard stack.
But isn't that premium inherently fragile? Like, how long can customers justify paying double? Especially the big hyperscalers watching every penny.
That's the constant tension. That's what drives the whole competitive dynamic. If Intel or AMD can reliably deliver, say, 90% of the performance for half the price on certain workloads, those CFOs are absolutely going to start asking very hard questions.
So how does NVIDIA defend against that cost pressure?
Aggressive, relentless reinvestment. They have to keep innovating. They have to deliver generational leaps in performance with each new architecture, like Blackwell coming after Hopper.
Resetting the bar constantly.
Exactly. Keeping the competition perpetually playing catch-up. They need to give those customers a compelling reason to keep paying the premium for the latest and greatest.
And the R&D spending reflects that pressure cooker environment.
Oh, massively. The numbers are huge. For the 12 months ending July 2025, their R&D spend was $15.384 billion.
Billion with a B.
Yeah. And that was up over 45% from the year before, a 45.54% increase. That's the cost of staying ahead. That's the investment needed to justify those 70% plus margins to those very demanding, cost-conscious customers. If that R&D engine ever slows down,
those margins could evaporate quickly.
Very quickly.
Okay, so dominance always attracts challengers, right? And the threats to NVIDIA's moat, they seem pretty serious and they come from different angles.
Yeah.
Let's start with the most direct one, hardware competition. Are rivals actually catching up on raw performance now?
They are definitely achieving near parity or even advantages in specific important metrics. And often they're targeting areas where they can offer that clear cost advantage we just talked about.
Like Intel's Gaudi 3.
Exactly. Gaudi 3 delivers around 1.8 petaflops of that low-precision AI compute BF16 FP8. That's very close to the H100's 1.98 petaflops on similar dense calculations.
Okay, hold on. Petaflops, BF16, FP8. Let's break that down quickly for listeners. Why are those the key terms now in AI chips?
Right, good point. So FLOPS means floating point operations per second. Peta means quadrillion, so it's a measure of raw calculation speed.
Got it. And BF16, FP8.
That refers to the precision of the numbers being crunched. Old-school scientific computing often needed high-precision 64-bit numbers, FP64, or 32-bit, FP32. But researchers discovered that for training many AI models, especially neural networks, you can get away with much lower precision.
Like 16-bit or even 8-bit numbers.
Exactly. BF16 is BrainFloat 16, and FP8 is 8-bit floating point.
Yeah.
Using these smaller data types means the chip can do vastly more calculations in the same amount of time and using less power. It massively boosts the effective petaflops for AI work.
So when Intel's Gaudi 3 matches the H100 on BF16 FP8 petaflops,
it means for the specific kind of math that dominates AI training and inference today, they are genuinely competitive on raw throughput. They're optimized for the same low-precision game.
Okay, so purely on a price per AI petaflop basis, Intel looks pretty good at half the price. Yet, those NVIDIA margins hold for now. What about AMD? What's their angle?
AMD's approach with their Instinct MI300X accelerator is a bit different. They're focusing heavily on memory.
Memory. Why memory?
Because these AI models, especially the big language models like GPT, they are enormous. They take up huge amounts of memory, and constantly moving data between the chip's memory and its processing cores, that becomes a major bottleneck. It slows everything down.
The memory bandwidth problem.
Precisely. The MI300X offers significantly more high bandwidth memory capacity and faster memory bandwidth compared to NVIDIA's H100.
So for workloads involving really huge models,
AMD can have a real performance edge. If your specific AI task is constantly hitting that memory wall, the MI300X might actually be faster, regardless of the raw petaflops number. It's a smart strategic attack vector.
Okay, so the hardware fight is definitely heating up.
Yeah.
Rivals are finding specific weaknesses or cost angles to attack, but they still run smack into that CUDA software wall, don't they?
They do, and that brings us to what is probably the single biggest, most significant long-term structural threat to NVIDIA's dominance.
The software wars, breaking the CUDA monopoly.
Exactly. This is the core existential battle for that $4 trillion valuation, I think. The rest of the industry knows they can't just win by making slightly cheaper or slightly different chips. They have to break the software lock-in.
And the main weapon in that war seems to be this UXL Foundation.
Yes. UXL, Unified Acceleration Foundation. It's this big industry coalition. You've got Google, Intel, ARM, Qualcomm, Samsung. A lot of heavy hitters are involved.
What's their specific goal? What are they trying to build to counter CDA?
Their mission is crystal clear. Create a viable, robust, open-source software ecosystem for accelerated computing. They're building on standards like Intel's One API.
Open source being the key difference from CDA's proprietary nature.
Absolutely. The ultimate vision is hardware agnosticism. They want developers to be able to write their AI code once using these open standards.
And run it efficiently on any hardware.
Any hardware. NVIDIA GPUs, AMD GPUs, Intel GPUs or CPUs, custom AI chips, FPGAs, whatever the underlying silicon is. Eliminate the vendor lock-in completely.
Okay, let's play that out. If UXL actually succeeds, if developers adopt it widely, and if they can prove that code runs just as fast or close enough on a cheaper Intel or AMD chip using UXL as it does on an NVIDIA chip using CDA, what happens then?
Well, that's the nightmare scenario for NVIDIA's current business model.
Yeah.
It would effectively commoditize the hardware layer underneath.
How so?
Because if the software layer becomes interchangeable, if CUA is no longer the mandatory best way to get performance, then the buying decision for hardware suddenly shifts. It becomes primarily about raw price, performance per watt, manufacturing costs.
All the things that drive down margins in commodity markets.
Precisely. It would shatter that platform premium that currently supports NVIDIA's 70% plus gross margins. The whole foundation gets shaky.
How close is UXL to achieving that today?
Right now, the open source alternatives are still generally seen as less mature, less performant, and having a smaller ecosystem than CUA. But UXL represents a massive, coordinated, well-funded effort by some of the biggest tech companies in the world to close that gap. It's a long-term play, but a very serious one.
And this threat is kind of compounded, isn't it? Because NVIDIA's biggest customers, the hyperscalers like Google, Meta, Amazon, Microsoft, they aren't just waiting for UXL. They're building their own potential threats internally.
Yeah, the custom silicon route, building their own ASICs application-specific integrated circuits.
Like Google's TPUs. Meta has their MTIA chips. Amazon has Inferentia and Trainium.
Exactly. These are chips designed in-house, tailored specifically for the exact AI workloads that dominate their massive data centers. Google's TPU is optimized for Google Search and their cloud AI services, for example.
Why do they bother? Isn't designing chips incredibly hard and expensive?
It is, but the motivation is pure long-term economics and control. Because these ASICs are custom-built for a narrow set of tasks, they can often achieve much better performance per watt, better energy efficiency.
Which is huge when you run data centers the size of small cities. Power is a massive cost.
A massive operational expense. And potentially, these custom chips can be 30% to 40% cheaper to produce or procure at scale than buying general-purpose GPUs from NVIDIA.
So better power efficiency and potentially 40% cheaper. That's a powerful incentive for a hyperscaler.
It's almost irresistible long-term. Now, NVIDIA's counter-argument is strong. Their general-purpose GPUs offer flexibility. They're essential when you're training new models, experimenting. When the AI architectures are changing rapidly, you need that adaptability.
Right. ASICs are fixed, GPUs are programmable.
But as AI models mature, as certain workloads become stable and predictable, like running inference, just using the trained model to answer user queries millions of times a day,
then the flexibility matters less.
And the efficiency and cost matter more. So the dynamic might shift. While NVIDIA totally dominates the training market today, they could face gradual erosion in the potentially even larger long-term inference market as hyperscalers deploy more and more custom silicon for those stable, high-volume tasks.
Unless NVIDIA can compete very aggressively on inference cost and power efficiency themselves.
Which is exactly what they're trying to do with new chip features and software, but it's a major battleground.
Okay, beyond the tech competition, NVIDIA's incredible growth path also bumps up against some big external forces. Macro risks. The most obvious one maybe is geopolitics.
Yes, specifically the ongoing tensions between the U.S. and China. These act as a really powerful non-market force on the business.
Through U.S. export controls.
Right. The U.S. government has put restrictions on selling the most advanced AI chips into China. They set specific performance thresholds, basically limiting the power of chips that can be exported.
Trying to slow China's AI development.
That's the stated goal. Now, NVIDIA has tried to navigate this. They've designed special compliant chips for the Chinese market, like the H800 and the H20. These are slightly detuned versions of their top chips, designed to fall just under the legal performance limits.
But how successful has that strategy been?
Well, the recent Q2 fiscal 26 report was pretty telling. It confirmed 0 sales of the H20 chip to China-based customers in that entire quarter.
0. That's a huge market to be effectively locked out of, even for the compliant chips.
It's a massive chunk of potential global demand they can't reliably access right now. And this has a really important structural impact that goes beyond just lost sales for NVIDIA.
What's that?
These export controls, they don't just hurt NVIDIA's revenue in the short term. They actively accelerate the development of competitive AI hardware outside the NVIDIA ecosystem, especially within China.
Because China has no choice but to invest heavily in domestic alternatives.
Exactly. When a country that size is barred from buying the best stuff off the shelf, they're forced to pour potentially trillions into building their own domestic AI infrastructure, developing their own chips, their own software stacks.
It creates a kind of protected incubator for non-NVIDIA technology.
Precisely. It gives local competitors, and maybe alternative architectures entirely, a sort of government-funded space to try and catch up, without facing the full competitive onslaught from NVIDIA right away. It inadvertently fuels that global push for hardware diversity and ways around the CUDA lock-in.
Okay, another risk factor is just market cyclicality.
Right.
NVIDIA is still fundamentally a semiconductor company, a tech stock. Those can be very boom and bust.
Yeah. Their history shows clear vulnerability here, high volatility. We saw their revenue take significant hits back in 2019 after a general tech downturn and again in 2022.
What caused the 2022 dip?
A big part of that was the cryptocurrency market crashing. Remember when crypto mining using GPUs was huge? That demand just evaporated almost overnight, leaving them with excess inventory.
Right, so they're exposed to these external market cycles.
Definitely. Now, to their credit, they've shown resilience. In both those cases, they bounced back to new highs within roughly 18 months or so. But the inherent risk is still there.
And the risk profile might be different now, given how dependent they are on the data center segment.
That's a crucial point. Data center is now the vast majority of their revenue. And that revenue comes primarily from a relatively small number of huge customers, the hyperscalers. Google, Meta, Amazon, Microsoft.
So if those companies slow down their spending,
the impact on NVIDIA could be immediate and severe. If the hyperscalers decide to pause or trim their massive data center buildouts, maybe because of recession fears, maybe they just hit a temporary saturation point on capacity in the world. NVIDIA feels that pain directly and instantly.
management has to be constantly watching that demand forecast.
Extremely vigilant. It's a tricky balancing act. That same Q2 FY26 report mentioned a $180 million release of inventory reserves they had previously set aside for the H20 chip.
The China chip they couldn't sell.
Right. Releasing that reserve helped their quarterly numbers, but it also highlights how sensitive they are to these supply-demand mismatches. Their fortunes are now very tightly tied to the capital expenditure cycles of just a handful of gigantic global companies. Hashtag tag outro.
Okay, let's try and pull all this together. We've gone through the history, the tech, the software moat, the financials, the competition, the risks. We started by asking, is this $4 trillion valuation built on silicon or is it built on software? What's the final verdict, the key takeaway for someone trying to understand this?
I think the valuation, while huge, is strategically defensible today. But that defensibility rests almost entirely on the platform premium.
Not just the chips.
No, it's the whole package. The vertically integrated system that DGX Super POD concept powered and optimized by the currently indispensable proprietary CUDA software ecosystem, that's the core.
So the battle isn't really about having the fastest chip in one specific benchmark anymore.
Not entirely. The crucial battleground has definitely shifted. It's now about ecosystem superiority. It's about locking in that massive developer base and ensuring the entire stack works together seamlessly.
So NVIDIA's main job now is, what, keep CUDA indispensable?
Essentially, yes. Their strategic imperative has to be ensuring that their full software stack CUDA itself, the NVIDIA AI Enterprise Suite, all the specialized libraries like cuDNN, the way it integrates with their hardware offers such a clear, demonstrable advantage in performance, stability, and ease of use.
That rivals just can't match it, even if UXL makes code boardable.
Exactly. They have to continuously prove that even if you can technically run your AI code on a competitor's chip using an open standard, it just won't run as fast or as reliably or be as easy to deploy and manage as it does on the full optimized NVIDIA stack. That's the value proposition they need to maintain.
Okay. And if you, the listener, want to track this ongoing fight the fight over whether AI compute becomes a commodity, what's the one number to watch?
It really comes back to that non-JAP gross margin.
The 70% plus number.
Yeah. If you see that number start to erode consistently,
Mm.
if it drops significantly and stays below 70% for a sustained period,
That's the signal.
that would be the clearest, most quantifiable signal that the CUDA software moat is actually being breached. That competitors, whether it's through UXL gaining traction or custom ASICs becoming efficient enough, or just pure price wars, are successfully dismantling that platform premium.
That's the point where AI infrastructure might really start to look like a commodity market. That would be the indicator, yes.
Yeah.
All right, so here's a final, maybe provocative thought for you to mull over after this deep dive. We talked a lot about how the gaming industry, with its insane demand for real-time calculations, unintentionally forced NVIDIA to build the parallel processing engines that ended up powering the AI revolution.
Right, that historical link.
So, considering NVIDIA is still pouring $15 billion a year into R&D, and they face these long-term threats from custom ASICs that are getting really good at today's known AI workloads like generative AI. The question to ponder is, what other non-obvious, incredibly high-intensity computing workload, something completely separate from the current Gen AI boom, might Jensen Huang be secretly investing in right now? What's the next unexpected proving ground that could fund their next big pivot beyond the Blackwell generation of chips?
That's a fantastic question. What's the next application that needs 36 trillion calculations a second but isn't today's AI? What's around the next corner?
Exactly. Something for you to chew on. Thanks for joining us for the deep dive.